Trend following falls in between buy and hold and market timing. And by market timing, I'm talking about jumping in and out of the market. And buy and hold, we all know what that is. So trend following is in between those two. Trend following attempts to buy and hold market leadership, and we want to sell and avoid market laggards. So if you picture a horse race, we want to stay invested in those lead horses. And we want to avoid those horses that say are back of the pack. Now as leads change, as some of those market leadership horses, if you will, start dropping back, we're going to want to replace those horses with the new market leadership. So trend following is quantitative based, a technical analysis. It's a philosophy that the markets themselves tell us all we need to know. We don't need to make market predictions. We're just going to go with the flow. Trend following is don't fight the tape, the trend is your friend. And trend following avoids opinions, which we believe is the single biggest reason for poor investment results. So how do we design and construct our portfolios? We start with the entire universe of mutual funds and exchange traded funds. We do not use individual stocks because we believe they are too volatile and have too violent trend reversals to be used in our portfolios. But we take that entire universe of mutual funds and exchange traded funds and we calculate a risk score for every single fund. Our risk score is a combination of maximum drawdown and the Ulster index. Maximum drawdown measures how far an individual mutual fund or ETF has dropped, say in a 1-year period from top to bottom. Ulster index is a measure of the velocity of how fast an investment declines. Those two risk calculations are basically what clients don't like: drawdown and having a fund drop very fast. So we calculate this with a combination of those two risk measurements. We calculate a risk score for every single fund. We rank those in order of risk, and we toss out or exclude all funds that have a risk that's higher than the S&P 500 index. That's usually excludes almost 50% of all the funds that we start with. We break the remaining funds down into deciles. So we calculate 0 as our least risky funds. That will be the lowest 10% risk scores among the funds we have surviving, to a 9, which will be our most risky funds. Once we have the risk down, we then want to calculate the trends on every mutual fund. There are 3 trends in any market. There's a short-term trend that lasts days to weeks. There's an intermediate-term trend that lasts weeks to months. And there's a long-term trend that lasts months to years. We calculate all 3 trends for all mutual funds and exchange-traded funds, and we combine those 3 trends into a combined trend score for every mutual fund and exchange-traded fund. So now we have a list of all mutual funds and exchange-traded funds. We have a risk score, we have a trend score, and we've excluded all funds that are riskier than the S&P 500 index. We can now construct our portfolios by taking the best trending funds within each risk class. We number our portfolios from 0 to 9. So our model portfolio 0 would be our least risky portfolio, and our model portfolio 9 would be our most aggressive portfolio. Now model portfolio 4, for example, will consist of funds in the risk classes 0 through 4. So it could hold funds ranked 0, 1, 2, 3, or 4 for risk, and we would try to build those portfolios with the best trending funds within those risk classes. The bulk of our clients are typically in our model portfolios 4, 5, and 6. Clients also have the ability to move. If they are concerned about the current market conditions and they are currently invested in our portfolio model 6, they could easily move down to model portfolio number 2. Now, once we have the portfolios designed and constructed, we have to have a portfolio monitoring system, and the way we do that is to monitor the funds that are in the portfolio on a daily basis. As funds start to lag, we're going to want to replace those with new market leadership. Morningstar, the service that ranks mutual funds, I'm sure you're all familiar with, is basically a trend following system. We categorize all of our investments by risk. Morningstar uses 69 different categories and categorizes each investment into a style like large cap blend or small cap value. Morningstar calculates risk-adjusted returns and awards 5 stars to the best trending fund, so to speak, within each category of those 69 categories. The difference between Morningstar and how we do it is that two things. One is they use 69 categories by investment style. We use 10 categories of risk. So we just trend follow within risk classes. They trend follow basically within investment styles. They also use a longer term trend. In other words, they weight 10-year risk-adjusted return 50%, 25% for the 5-year, 25% for the 3-year, where we use much nearer term performance. Our long term is only 1 year, intermediate term 3 months, and short term is 1 month. Trends persist much longer than investors think. We're really trying to catch those trends that last 3 to 6 years. We're not looking to jump in and out day trading or anything silly like that. We really want to catch those long-term trends. A great example is large cap growth stocks that were consistently a great place to invest from 1994 to 1999, but they're a terrible place to invest from 2000 to 2005. Why asset allocation has not worked very well. The most popular form of asset allocation is strategic asset allocation. Think of it as a static asset mix. You've seen these pie charts numerous times. Each slice of pie, so to speak, is a different investment style, but it ignores completely current market conditions. Typically, a third or more of the pie slices are not working. For example, I've seen many asset allocation strategies hold a fixed allocation, say, of 10 to 20% in real estate, even in the markets like 2007 to 2008, when real estate was continuing to decline. But for diversification purposes, the asset allocation theorists said that you must hold real estate. We think that's a tad silly. Asset allocation did not prevent losses in bear markets of 2000 to 2002, nor did they help investors during the crash of 2008. So asset allocation does not assure profit or prevent a loss. Asset allocation is based on modern portfolio theory, a theory I might add, and markets don't typically follow theory. Trend following is not perfect. Trend following will not get you in at the bottom because the trend first has to get established. Trend following will not get you out at tops because the trend must roll over first. But my experience has been that you don't have to be so smart to buy at bottoms and sell at tops. That if you catch the major trends that typically last 3 to 5 years, you're going to do just fine. I can tell you like right now what is best trending in the markets right this minute. But my biggest concern are the trend reversals because we know at some point those trends will change. So why do investors fail? I believe it's that they have no overall well thought out portfolio design and construction. They have no clearly articulated investment strategy. There's no clear investment monitoring system because once you buy an investment, it has to be followed and followed closely. And there's little attention paid to true risk management, to defense. And remember, great defense makes for championship teams. There's also too much reliance on opinions and predictions. And with the use of a financial advisor, I don't see a lot of use of model portfolios, and it is physically impossible for a financial advisor to look at each of his clients' portfolios on a daily basis. Our clients have a lot of money, our clients are risk averse, and our clients want slow and steady portfolio growth. With trend following, we attempt to deliver on those objectives.